What if I told you that a company could shatter every single financial record in its entire history, the best quarter it has ever had, bar none, and still watch its stock get absolutely obliterated by the market? Not a small dip, not a minor pullback, a full-blown collapse while the business itself is firing on all cylinders. Could that even happen? Should that ever be allowed to happen? Welcome back to Smart Stock Sam, the channel where we do not trade on feelings, we trade on facts, and today the facts are going to blow your mind. Before we even get into the numbers, let me give you the complete picture up front, because this is one of those videos you are going to want to watch all the way through. Today we are going to talk about a stock that just posted 85% revenue growth, that is printing cash at a margin most tech companies would sacrifice anything to achieve, and that is simultaneously sitting in what could be the most dangerous valuation trap on Wall Street right now. We are going to talk about what Wall Street's biggest money managers are quietly doing behind closed doors, a geopolitical firestorm burning across Europe that almost nobody in mainstream financial media is covering, and then we are going to give you the exact price levels, not guesses, not vibes, the concrete data-backed levels you need to have on your radar for the rest of this year. If you have ever typed the words, "Should I buy Palantir?" into a search bar, you cannot afford to miss a single second of what we are about to break down. Let us start with the big picture, because this is the entire battleground for this stock in one image. Imagine two lines on a chart. One is green and it is pointing aggressively upward. That is the fundamental health of the underlying business. Q1 revenue up 85% year over year. U.S. commercial growth up a staggering 133%. These are the kind of numbers that, in any other era, would send a stock to the moon within hours of reporting. Then there is the red line. Despite all of that record-shattering performance, Palantir's stock is actually down over 26% year-to-date. Down. While the business grew faster than it ever has in its entire existence, that is not a small discrepancy. That is a fundamental structural disconnect between what the company is doing and what the market is willing to pay for it. And understanding exactly why that gap exists and whether it will close upward or downward is the entire game right now. Let us establish our baseline. As of our latest data, Palantir closed at $128.47. That price puts the stock a painful 38% below its 52-week high of over $207. We are talking about a nearly $308 billion company that has shed more than a third of its value from the top, even while growing revenues at a pace most companies only dream about. The volume profile on recent trading days tells you everything: erratic, highly volatile swings. You have retail investors desperately trying to find a floor, fighting algorithm-driven institutional selling that does not care about your conviction or your average cost basis. This is a war zone, and you need both sides of the story before you walk in. Now let us talk about the upward force, because the bull case for Palantir is genuinely extraordinary and deserves to be understood in full before we get to any of the risks. Q1 of 2026 was, simply put, a masterclass in execution, and the kind of quarterly print that most software companies would spend a decade trying to replicate. Total revenue came in at $1.63 billion. That 85% year-over-year jump we mentioned. What makes that even more remarkable is that this was the 11th consecutive quarter of accelerating revenue growth, not just growing, accelerating. Every single quarter for nearly 3 years, the growth rate has gotten faster, not slower. Think about what that means mathematically. Sustaining acceleration across 11 straight quarters is nearly impossible for a company this size, and yet here we are. But the metric that should genuinely stop long-term investors in their tracks is net dollar retention, which came in at 150%. For anyone newer to software investing, here is what that means in plain English. The customers who were already paying Palantir last year spent 50% more this year. They did not just renew. They expanded. They went deeper. They became operationally dependent on the platform. That is not a loyalty metric. That is a lock-in metric. Combine that with a 31% jump in their total customer count, And what you have is a revenue machine that is growing in two directions simultaneously. New customers arriving and existing customers spending more. The single biggest catalyst for all of this is their artificial intelligence platform, known as AIP. Here is what separates AIP from every other AI product being sold right now, and I want you to think carefully about this distinction. While most tech companies are selling glorified chatbots, tools you can ask questions to and get summaries from, Palantir is doing something categorically different. They are embedding large language models directly into live, production-level operational control systems for Fortune 500 companies. Real decisions, in real time, in real business environments. The commercial traction has been undeniable. U.S. commercial revenue alone is up 133% year over year. Total contract value bookings in the commercial space rocketed 45% to $1.2 billion. Analysts at Wolfe Research recently upgraded the stock, describing Palantir's product-market fit as, and this is a direct characterization, too big to ignore, in a total addressable market they peg at $385 billion. But if you want the single most impressive data point in this entire story, it is the Rule of 40 score. In software investing, the Rule of 40 is the industry's gold standard health check. You take a company's revenue growth rate, add it to its profit margin, and if the combined number hits 40% or higher, you have got yourself an elite-tier business. Palantir did not hit 40. They did not hit 80. They scored 145% on the Rule of 40, with adjusted operating margins of 60% and free cash flow margins of 57%. CEO Alex Karp made the observation, and the data backs him up completely, that Palantir now sits in an exclusive club of companies that are growing at hyperspeed while simultaneously printing extraordinary levels of cash. The only peers in that bracket right now are AI hardware giants. For a software company, this level of operational efficiency is almost without precedent. So if the business is operating at this level, why is the stock getting punished? This is where the fairy tale meets gravity. Palantir is currently trading at a trailing price-to-earnings ratio of roughly 142 to 146 times earnings. Forward-looking, the stock still trades at nearly 88 times expected earnings and an eye-watering 60 times sales. Let those numbers land for a second. At those multiples, the stock does not just need to keep performing well, it needs to perform perfectly. There is zero margin of error priced into this valuation. Any stumble, any missed metric, any negative headline creates the conditions for what the market calls multiple compression, and that can be violent, fast, and deeply painful for anyone who bought in at peak optimism. This is precisely why legendary investor Michael Burry, the man immortalized by The Big Short, recently flagged Palantir's $300 billion-plus valuation as what he called a sand castle, a structure resting on an AI narrative that could wash away faster than the market expects. Now let us follow the money, because what institutions are doing right now tells you more than any analyst note ever will. Vanguard Group, one of the single largest passive investors on the planet, recently slashed its Palantir holdings by over 10%, offloading nearly 198 million shares. When a fund of that scale reduces a position by double digits, it removes a massive structural pillar of support from the stock. But the insider activity is where it gets really uncomfortable. In late May, CEO Alex Karp and other senior executives executed concentrated share sales of over 880,000 shares. Now, we always need to acknowledge that some of this is standard compensation liquidity. Executives sell shares as part of how they are paid, but the timing, the scale, and the current valuation context all point in the same direction. The people who know this business better than anyone on earth are comfortable selling at these prices. That is information you need to take seriously. And now we need to talk about the geopolitical story that most financial channels are not covering with nearly enough urgency, because this risk is real, It is escalating, it has already cost Palantir real revenue, and it is actively shrinking their international addressable market in real time. This is not a hypothetical future risk, it is happening right now. In the United Kingdom, a £330 million NHS contract is currently under severe regulatory scrutiny, with probes surfacing troubling allegations that hospitals using Palantir's platform are actually performing fewer operations, not more. In Switzerland, Palantir just lost a major lawsuit centered on data privacy violations, and the German military has announced it is actively stepping back from Palantir products. Europe is not merely uncomfortable with American data companies, it is becoming structurally hostile to them. The most alarming case study is France, and this one should make every U.S. tech investor genuinely nervous. The French Prime Minister recently made a statement that should send chills through any boardroom that sells sensitive software to foreign governments. The direct position from the French government is that they cannot accept new strategic dependencies in the digital sphere. Because of the demonstrated ability of the U.S. government to restrict foreign access to American technology tools, Europe has entered a full-scale panic around what they are calling digital sovereignty. France is now injecting hundreds of millions of euros into domestic AI development and has already begun replacing Palantir's software at the DGSIE, their domestic intelligence agency, with a French startup called Chaps Vision. Palantir maintains that the contract remains in force for now, but the trajectory is unmistakable. Foreign governments are no longer comfortable entrusting their most sensitive national security data to a private American company. That is not a headwind, that is a structural reordering of the market. Let us now look at the options market, because this is where institutional money leaves its fingerprints, and the picture it paints right now is extremely precise. The options gravity map for the upcoming expiration tells us exactly where the big money is structurally positioned and where the stock is likely to be pinned. Above the current price, there is a staggering 6,738 open call contracts sitting at the $133 strike. That acts as a concrete ceiling. Market makers will heavily defend that level, and pushing through $133 right now would require an enormous, sustained wave of buying volume that simply does not exist in the current macro environment. To the downside, the primary safety net is at the $125 strike, where over 3,400 put contracts are acting as structural support. Between $125 and $133, that is the box. That is where this stock lives until something fundamentally breaks the option structure. The technical picture reinforces this read almost perfectly. Across the major momentum indicators, the consensus is a strong sell signal. The stock is currently trading below both of its major moving averages. It has broken beneath the 50-day simple moving average, which sat at $130.99, and that level has now flipped. What was support has become dynamic resistance. The 200-day moving average is above the current price as well, creating a double ceiling effect. The relative strength index is sitting at approximately 42, meaning momentum is bleeding out, but the stock has not yet reached the oversold territory that typically triggers a reflexive bounce. The MACD has confirmed a negative crossover. Every major technical signal is pointing the same direction. The trend is not your friend right now on this name. And before someone in the comments brings up the short squeeze theory, let us address it directly and put it to rest with actual data. Short interest in Palantir sits at just 3.15% of the total float. The cost to borrow shares for shorting purposes is literally 0.28%. That means short sellers are paying nearly nothing to maintain their bearish positions. They are relaxed, they are comfortable, there is no mechanical pressure building that will force short sellers to cover and drive the price artificially higher. A GameStop-style squeeze on Palantir is not just unlikely. The data tells us it is structurally impossible under current conditions. So let us bring all of this together into the concrete scenarios you actually need to have in your playbook heading into the second half of this year. The base case, and this is where we are living right now, puts Palantir trading sideways between $120 and $160 as the company attempts to, in market terms, grow into its valuation. The multiple stays elevated, the growth continues, but the stock goes nowhere dramatic in either direction. If you are a long-term investor with a genuine multi-year horizon and the stomach for volatility, this chop is your accumulation window, but only if the fundamentals remain intact and Europe does not deteriorate further. The bear case puts Palantir between $90 and $110, and the trigger for that scenario is either a broad tech sector rotation out of high multiple AI names driven by rising interest rates or a confirmed cancellation of that £330 million UK NHS contract. That headline alone has the power to slice through the $120 support level instantly and trigger a cascade of stop-loss selling. The bull case sits between $180 and $210, but reaching it requires Palantir to announce major unexpected U.S. commercial wins large enough to definitively offset European losses, and a clean, high-volume break back above that $133 option ceiling that holds for multiple consecutive sessions. Before we close out today, Smart Stock Sam is required to be transparent with you. Nothing discussed in this video constitutes financial advice. This content is strictly for educational and informational purposes only. All investment decisions carry risk, and past performance of any stock or sector is never a guarantee of future results. Always conduct your own due diligence and consult a qualified financial professional before making any investment decision. We are here to sharpen your thinking, not to manage your money. So where does that leave us? Do not buy the hype. Do not buy the panic. Respect the $125 support. Fear the $133 resistance. Let the data, not your emotions, drive every single decision you make on this stock. Palantir is one of the most fascinating and complex setups in the entire market right now. And the investors who will win here are the ones who have the discipline to wait for their level and the knowledge to act when the data confirms it. Here's your question for the comments today, and I genuinely want to see your reasoning. If Palantir's next quarterly report shows U.S. commercial growth continuing above 100%, but European revenues fall by 20% year over year, is that a buy signal, a sell signal, or do you hold? Drop your answer below and tell me exactly why. Your thinking might sharpen someone else's, and that is what this community is built on. If this breakdown gave you something valuable today, hit the like button right now. It helps us reach more investors who need this level of analysis. Subscribe to Smart Stock Sam so you never miss a data-driven breakdown like this one. And if you really want to support the channel and the research that goes into every single video, you can send a super thanks directly through YouTube. Every single contribution goes right back into the research and tools that make content like this possible. One more thing before you go. We have just launched the Smart Stock Sam exclusive membership community, and this is where the real conversations happen. Members get access to deeper analysis, early video access, and a community of serious investors and traders who are committed to leveling up their financial intelligence. If you are tired of getting noise and you want meaningful analysis, join us. The link is right below this video. We will see you in the next breakdown.